Imagine stealing billions of dollars, like pulling off one of the largest financial crimes in history,
Right.
and doing it not with high-tech offshore hackers or, untraceable algorithmic backdoors, but using small business accounting software and a faded t-shirt.
Yeah, it defies literally every assumption we have about high finance.
Today, we are looking at how a 30-year-old convinced the smartest people on Wall Street to just hand him their money.
I mean, the expectation is always that an impenetrable vault protects billions of dollars, right? You expect 3-foot thick steel doors and armed guards.
Exactly.
But the security apparatus we were looking at today was practically made of cardboard. It was the absolute definition of security theater.
So welcome to this custom deep dive into that very illusion. For you listening, we've got a massive stack of sources in front of us today.
They really do.
We are combing through legal filings, journalistic investigations, and first-hand accounts covering the meteoric rise and catastrophic collapse of the cryptocurrency exchange FTX.
And its sister trading firm, Alameda Research.
Right. And of course, the architect of it all, Sam Bankman-Fried.
The sheer volume of material is just staggering, particularly when you look at the bankruptcy reports and all the internal communications that eventually leak to the public.
Oh yeah, the leaked chats are wild.
They really are. We basically have a front row seat to one of the fastest financial meltdowns in modern history.
But I want to set a very clear mission for you as we go through this material. We are not here to get bogged down in the complex, mind-numbing mechanics of blockchain technology or heavy financial jargon.
Thankfully.
Right. Instead, we are exploring the human psychology of trust and deception.
Yes, that is the real story here.
We want to understand how someone could become the most trusted, the most quote-unquote responsible face in an entire global industry, all while running a shockingly simple multi-billion-dollar fraud right beneath the surface.
Because before you can understand the crime itself, you really have to look at how this person built an almost impenetrable shield of credibility.
Okay, let's unpack this. We're talking about Sam Bankman-Fried, who everyone in the media and finance world just called SBF.
Right.
By November 2022, at just 30 years old, this guy was worth an estimated $16 billion.
Which is just an unfathomable amount of money for a 30-year-old.
It is, and he was everywhere. I mean, he was on the covers of major financial magazines. He was sharing stages with former U.S. presidents like Bill Clinton.
Yeah.
He was even sitting in front of the United States Congress, literally testifying on how the cryptocurrency industry should be regulated.
What's fascinating here is how he positioned himself. He wasn't just presenting himself as a successful businessman,
What do you mean?
Well, he was acting as a statesman for an industry that was widely considered to be a regulatory Wild West. He was flying to Washington, D.C., sitting down with lawmakers, and essentially offering to help them write the rules.
Wait, hold on. This is where I get hung up. Because you look at the footage of him at these high-level meetings, and he's sitting next to billionaires and politicians wearing cargo shorts, white tube socks, and a wrinkled T-shirt.
Right. The infamous wardrobe.
Yeah. You would think the smartest venture capitalists in the world would want to hand their money to a guy in a tailored suit. How did the sloppy, unkempt look not set off massive alarm bells?
So there is a specific psychological phenomenon at play here, especially in Silicon Valley.
Okay.
He didn't succeed in spite of his unkempt appearance. He actually succeeded because of it.
Wait, really? Because of the cargo shorts?
Basically, yeah.
Yeah.
In the tech world, a total lack of corporate polish is frequently misinterpreted as a signal of raw, unfiltered genius.
Oh, I see.
Investors look at a guy playing video games during a pitch meeting at a T-stream and think, oh, he's so focused on the code and the math that he just doesn't have time for social norms.
Oh, wow.
Yeah. They interpreted a lack of traditional corporate polish as a lack of traditional corporate deception.
So the shorts were basically a costume.
Effectively, yes. And we also have to look at the macroeconomic environment of that time. We were in a period of near zero interest rates.
Right. Money was basically free.
Exactly. Money was incredibly cheap to borrow, and traditional investments weren't yielding high returns. Venture capitalists were desperate for places to put their money that would generate massive profits.
So they were just looking for the next big thing.
Yeah, and that desperation bred a profound fear of missing out, or FOMO. When investors are terrified that a rival firm is going to back the next trillion-dollar company instead of them, well, they start skipping their standard due diligence.
They just throw money at it.
Right. They didn't demand board seats. They didn't demand independent audits. They just wanted in.
And it wasn't just the tech genius persona that got them in. The sources highlight that he heavily promoted a philosophy called effective altruism.
Yes, that was a huge part of his image.
He wasn't just getting rich to buy yachts and private jets, right?
Yes.
He was loudly pledging to give his massive fortune away.
He signed the giving pledge and everything.
Exactly. He was funding nonprofits to prevent existential threats like future pandemics and rogue artificial intelligence. He basically built this absolute halo around himself.
Well, effective altruism is a fascinating philosophical movement on its own.
How so?
The core premise is about using rational, evidence-based methods to do the most good possible. SBF championed a subset of this called earning to give.
Burning to give.
Right. The argument was that he could do more good for the world by making billions on Wall Street and donating it than he ever could by working directly for a charity.
Oh, that's clever.
And he institutionalized this narrative. He brought on prominent philosophers to help run his future fund. He created an environment where questioning his business practices felt like questioning the very concept of saving humanity.
I mean, think about the human psychology of the halo effect here. If someone is literally sitting in front of Congress, asking for more regulation and pledging his fortune to stop the next pandemic, our brains automatically assume their own house must be perfectly in order.
Exactly. It's a psychological blind spot.
It's exactly like trusting a doctor implicitly just because he saw them preaching about healthy eating and daily exercise on morning television. You don't assume the guy lecturing the nation on heart health is going home and eating deep-fried butter for every meal.
Right. And that creates immense cognitive dissonance for an auditor or an investor.
Yeah, how could the good guy be the bad guy?
The human brain naturally asks, why would someone dedicating their life to saving the world be stealing my money? It completely short-circuits our standard fraud detection mechanisms.
Which is terrifying.
Because the broader crypto market was viewed with such suspicion, full of anonymous developers and obvious scams, SBF's apparent transparency made him the safe harbor.
But the reality of that safe harbor is where this story takes a sharp turn into the bizarre. We move from this pristine, world-saving public image to the chaotic, fraudulent reality hidden right behind the curtain.
And it was incredibly chaotic.
Let me stop you here because I'm actually still a bit confused about the corporate structure. We keep hearing about multi-billion-dollar crypto fraud, and my brain immediately conjures up images of elite hackers, complex algorithms, offshore shell companies, and cryptographic backdoors. What were these two companies, FTX and Alameda, actually doing?
Let's break down the mechanics. You had FTX, which functioned as a cryptocurrency exchange.
All right.
Think of it like a digital brokerage. You, the customer, deposit your dollars or your Bitcoin onto the FTX platform so you can hold it or trade it.
Got it.
FTX makes its money simply by charging tiny transaction fees on every trade. It is supposed to be a completely secure vault for your assets.
Okay, so FTX is the vault. What was Alameda Research?
Alameda Research was SBF's completely separate quantitative trading firm.
So totally different company.
In practical terms, it was a crypto hedge fund that took massive, highly speculative risks to generate profits. On paper, to the public and to regulators, these were two entirely separate corporate entities with an absolute firewall between them.
Right, on paper.
But the sources reveal that Alameda functioned as a primary market maker for FTX early on.
And market maker means what exactly in this context?
A market maker provides liquidity to an exchange. When you want to sell a token on FTX, you need a buyer immediately. Alameda would step in to be that buyer, or vice versa.
Oh, I see.
Right, making a tiny profit on the spread between the buying and selling price. But having your own hedge fund act as the primary market maker for your own exchange is a massive, glaring conflict of interest.
It sounds like it.
Imagine walking into a casino and the house can see the exact cards you are about to play before you even put your chips down. They can trade against their own customers.
Here's where it gets really interesting. It wasn't just that they were trading against customers. They literally hard-coded a backdoor into the system.
Yes.
The sources talk about this auto-liquidation protocol. Can you explain how that worked?
So in crypto trading, particularly when trading on margin or borrowed money, the markets are highly volatile. If your account drops below a certain value, the exchange's computer system automatically liquidates your assets, selling them off to prevent wider losses that could bankrupt the platform.
That makes sense.
It's an automated safety mechanism that applies to every single trader, except they secretly wrote a few lines of code granting Alameda an exemption.
Wait, so Alameda could just lose millions of dollars in bad trades, And the system would never liquidate their account.
That is correct. They were immune to the rules everyone else had to follow. Furthermore, that hidden code granted Alameda an essentially unlimited line of credit on the FTX exchange.
Hold on. I really want to emphasize this point for anyone listening, because this is the part that completely shatters the illusion of the sophisticated financial criminal.
Yeah, it really wasn't sophisticated at all.
They didn't invent a complex new derivative. They didn't hack a blockchain. They simply took customer money, the funds regular people deposited on FTX for safekeeping, and funneled it directly to Alameda to play with.
It's as simple as that.
It's exactly like depositing your hard-earned paycheck at a well-lit, reputable bank, only to find out the bank manager just opened the vault, handed your cash to his roommate, and sent him off to day trade in Vegas.
The mundane simplicity of the theft is staggering. And what they did with that customer money is even worse.
Oh, the spending was insane.
Right. The funds were used to cover Alameda's staggering trading losses, but they were also used to fund a lavish, unchecked lifestyle.
Yeah, I read about the real estate.
The bankruptcy filings detail a $40 million luxury penthouse in the Bahamas where the executives lived and worked.
$40 million.
And they took customer deposits to buy the naming rights to the Miami Heat's basketball arena for $135 million. They spent an estimated $30 million on a single Super Bowl ad.
Wait, I remember that ad. It had Larry David in it.
Yes, they paid massive endorsement fees to celebrities. Tom Brady, Steph Curry, Larry David. All of this cultural cachet was being fueled by the quiet siphoning of billions of dollars of everyday people's checking and savings accounts.
And it wasn't just the spending, it was how incredibly terribly the actual business was being run behind closed doors.
Oh, it was from that.
When the whole thing collapsed, a man named John J. Ray III took over as the CEO to handle the bankruptcy. For context, this is the lawyer who oversaw the liquidation of Enron.
Which was massively complex.
Exactly. He is the preeminent expert in unraveling massive, complex corporate disasters. And he stated, on the record, in a legal filing to the bankruptcy court, that in his nearly 40 years of experience, he had never seen such a complete failure of corporate controls.
That is a staggering statement coming from him.
He basically said the Enron fraud was highly sophisticated, but this was just taking the money.
Yeah, Ray's testimony to Congress laid out a level of incompetence that is just hard to comprehend. He noted there was essentially no record keeping.
None.
We're talking about a company handling billions of dollars in global transactions, valued at one point at $32 billion, and they were literally using QuickBooks for their corporate accounting, software designed for small, local businesses.
I use QuickBooks to track my freelance writing invoices. The idea that a global financial empire was using it while secretly siphoning customer deposits is just... it's hard to wrap your head around.
It really is.
The sources also mentioned they were approving multi-million-dollar corporate expenses via emojis on a vanishing chat app.
Right. Signal, I believe.
Yeah. Think about the apps on your own phone right now. You trust the code to do what the interface promises. SBF proved that a single hidden line of code overrides all the PR in the world. But how did they hide a hole that big for so long?
If we connect this to the bigger picture, it comes down to market conditions acting as camouflage. A booming market is the ultimate mask for terrible behavior.
Because everyone is making money.
Exactly. Throughout 2020 and 2021, cryptocurrency prices were skyrocketing. When everyone is making money on paper and massive new deposits are constantly flooding into the exchange every single day, no one is asking to withdraw all their funds at once.
So there's always enough cash on hand to cover the daily withdrawals.
Right. The shortfall, the billions that were missing, because Alameda had spent them, remained entirely invisible. As long as the music kept playing, the illusion held. It relied entirely on the basic premise that a bank run wouldn't happen.
But of course, the music always stops.
Always.
Which brings us to how a fraud this incredibly simple finally unravels. We move from the actual mechanics of the theft to the psychological collapse, the cognitive dissonance of the fraudster when the truth starts leaking out.
The unraveling was incredibly swift. It started in early November 2022 when a crypto news site called CoinDesk published a leaked balance sheet from Alameda Research.
Hold on, I'm stuck on this detail in the sources. The balance sheet showed they were mostly holding something called FTT.
Yes.
I thought they were playing with billions in real customer cash. What is FTT, and why did a leaked balance sheet matter so much?
So FTT was a proprietary cryptocurrency token created by FTX itself.
Oh, okay, so they made it up.
Basically, it was essentially a loyalty token for the exchange. If you held it, you got trading discounts. But the issue was the concentration.
What do you mean?
FTX created millions of these FTT tokens out of thin air, held the vast majority of the supply tightly so the public price would look incredibly high, and then Alameda used those highly inflated, illiquid FTT tokens as collateral to borrow real customer dollars from the FTX vault.
Let me make sure I have this straight. It's like me printing 1,000,000 deep dive books on my home computer printer, declaring to the world they are worth $1 each, and then using my stack of homemade paper as collateral to borrow real, actual cash out of your physical wallet.
That is a perfect encapsulation of the mechanics.
Wow.
It is a textbook circular economy based on entirely fabricated value. When that balance sheet leaked, the broader market realized that Alameda's supposed billions in assets were actually just tokens invented by their sister company.
So the perceived value evaporated instantly,
Exactly.
and the dominoes fell fast. Changpeng Zhao, the CEO of Binance, which was FTX's biggest rival in the crypto space, tweeted that based on these revelations, Binance would be selling off all their FTT tokens.
Right, and that single tweet was the catalyst.
Just one tweet.
It sparked widespread panic.
Yeah.
Customers realized what we were just talking about. If Alameda's assets are fake, is my real money actually safe at FTX?
And that realization triggered a classic bank run.
Exactly. Customers rushed to the platform to withdraw their funds. Over a span of just 72 hours, FTX saw roughly $6 billion in withdrawal requests.
$6 billion in 3 days.
Yeah, and, as we know, the vault was empty. The money had been sent to Alameda and spent on risky trades, venture investments, and Bahamian real estate.
Within days, the company went from a $32 billion valuation to filing for Chapter 11 bankruptcy.
A total collapse.
But amidst all that chaos, there's this striking display of deception that really gets to the core of SBF's psychology. While the bank run is actively happening, he's on Twitter publicly stating, FTX is fine, assets are fine.
Right, lying to the bitter end.
He's trying to maintain the illusion to the very last second. But at the exact same time, he's having a private conversation via Twitter direct messages with a reporter from Vox, Kelsey Piper.
Those leaked messages are perhaps the most revealing document in the entire archive.
They really are.
They strip away the entire persona he spent years meticulously building for the public and the regulators.
It's stunning to read. The reporter asks him about all his ethics crusades, the effect of altruism, the regulatory push in Washington, and SBF admits in private that it was all just PR.
Yeah.
He literally called his own ethical posturing a dumb game we woke Westerners play where we say all the right shibboleths and so everyone likes us.
Just completely cynical.
He explicitly stated that regulators make everything worse and don't protect customers at all.
It is a breathtaking admission of bad faith. He is acknowledging in his own words that he consciously manipulated the cultural and political language of the moment to shield a criminal enterprise.
Telling people what they wanted to hear.
Exactly. He gave the media and the politicians exactly the narrative they wanted to hear so they would stop looking at the math.
So what does this all mean? The sheer audacity here is what gets me. This is a guy who was actively lobbying Congress for a piece of legislation called the Digital Commodities Consumer Protection Act.
Right. He was the face of consumer protection.
He was walking the halls of Washington, D.C., telling lawmakers he wanted to write the rules to protect consumers while simultaneously running a machine that was executing the largest consumer scam in recent history.
And the people who actually knew the truth couldn't hold the lie together once the legal pressure hit.
The inner circle.
Yeah, the top executives in his inner circle, Caroline Ellison, who ran Alameda, Gary Wang, the co-founder, Nishad Singh, the director of engineering, they all eventually flipped.
They all turned on him.
They took plea deals and testified against SBF in federal court.
And they confirmed everything, didn't they?
They laid bare the fact that this wasn't an accident. It wasn't a complex financial strategy gone wrong due to unexpected market conditions.
Like SBF tried to claim.
Exactly. They testified that they all knew customer funds were being siphoned off using those simple tweaks to the computer code. It was intentional, systemic theft orchestrated from the very top.
And it caught up to him.
It did. SBF was ultimately convicted on multiple counts of wire fraud, securities fraud, and money laundering. In March of 2024, he was sentenced to 25 years in federal prison.
A complete and total collapse of the prodigy narrative.
Completely.
And I want to speak directly to you, the listener, for a second as we wrap this up. Because you might be thinking, well, I don't own any cryptocurrency. I don't trade on margin. I use a traditional bank. So why does this deep dive matter to me?
It's a fair question.
It matters deeply because the story of FTX isn't actually a story about the blockchain or digital tokens. It is a timeless, repeating lesson about human nature.
Absolutely.
It proves that a polished image, the right celebrity associations, and fluency in the current cultural buzzwords can perfectly mask a total lack of substance. SBF proved on a global scale that confidence does not equal trustworthiness.
This raises an important question about how we as a society assign trust. Our brains are hardwired to look for shortcuts.
We want to believe the shortcuts.
We really do.
Mhm.
We look for the signals of responsibility. Things like charitable pledges, magazine covers, endorsements from elite athletes, and appearances before Congress.
Right.
We assume that if someone has passed through those societal filters, they must have been thoroughly vetted. They must be legitimate. But the FTX collapse forces us to confront a very uncomfortable reality.
What's that?
If it was this easy for a 30-year-old in a T-shirt to fool some of the most sophisticated venture capitalists, regulators, and journalists in the world using QuickBooks and a fabricated public persona,
Yeah.
well, how many other trusted institutions or charismatic leaders in our daily lives might be operating their own version of a piggy bank right out of sight?
It really makes you look differently at that 3-foot-thick solid steel bank vault door, doesn't it? Because maybe the door's real, but you still have to wonder what the manager's doing with the cash once the door swings shut. Keep questioning the architecture.